Welcome to This Explainer. Today, we're cutting straight to the precise distinctions between three terms that frankly trip up a lot of trainees and professionals alike: materiality, performance materiality, and the clearly trivial threshold. It's easy to accidentally use these interchangeably in conversation, but the auditing standards demand exactness. Misunderstanding them isn't just an exam risk, it can lead to catastrophic audit failures. So, let's separate them completely. Here's the roadmap for our discussion today. We'll start with the three different terms, move into financial statement materiality, define performance materiality, look at the clearly trivial threshold, and wrap up with revisions during the audit. Section 1, the three different terms, setting the standards. To get this right, we need to anchor our concepts to the correct frameworks. Standard on Auditing 320, on materiality in planning and performing an audit, handles the first two terms we'll discuss. Then, a distinct standard, Standard on Auditing 450, on evaluation of misstatements identified during the audit, introduces the third concept. Knowing exactly which standard applies is your foundation here. Section 2, Financial Statement Materiality, the headline figure. So, Standard on Auditing 320 begins with materiality for the financial statements as a whole. Think of this as the headline figure you determine right at the planning stage. It's the overarching scale for the engagement, the threshold above which misstatements could reasonably be expected to influence the economic decisions of users who are relying on those financial statements. Now, we need to state plainly what materiality does not cover. It is fundamentally a judgment about users. It is not an arithmetic exercise. Sure, in practice, you're usually going to express it by applying a percentage to a benchmark, like profit before tax, but never forget that the ultimate foundation is a professional judgment regarding user influence, not just doing the math. The standard also carves out a specific situation alongside that headline figure. It mandates a separate, lower materiality level for specific classes of transactions, account balances, or disclosures. Think related party transactions or director's remuneration. The monetary amount itself might be quite small, but the sensitivity to the users is high, meaning a smaller misstatement could still easily influence their decisions. Section 3. Defining performance materiality, the working margin. So how do we actually protect that headline figure in practice? Well, that takes an entirely separate concept, performance materiality. This is probably the most commonly misunderstood term by trainees. It's an amount set intentionally lower than overall materiality. Why? To reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds that overall financial statement materiality. The logic here is highly practical. As an auditor, you just aren't going to find every single misstatement. Some will slip through because of sampling risk, some are individually small, and these uncorrected errors naturally accumulate over the course of the audit. If you only tested your samples against the headline figure, a whole collection of misstatements sitting just below that line could easily add up to something well above it. The result? A materially misstated financial statement and a failed audit. Performance materiality builds in a working margin. It's the practical, day-to-day threshold you apply when determining the nature, timing, and extent of your audit procedures. Section 4. The clearly trivial threshold, the absolute floor. Let's shift gears to Standard on Auditing 450. This standard dictates that the auditor must accumulate misstatements identified during the audit, unless they are clearly trivial. So what does that mean? Clearly trivial describes amounts that are wholly inconsequential, whether you look at them individually or in aggregate, and about which there is absolutely no doubt at all. We must state plainly a common and honestly fatal error trainees make. Clearly trivial does not mean immaterial. Treating those two words as synonyms is a guaranteed way to lose marks in an exam, and it's a critical flaw in actual practice. Immaterial items sit well above the trivial line. They still have to be accumulated, evaluated, and communicated to management. Clearly trivial items, on the other hand, are the only ones so tiny that they can be safely ignored entirely. Which brings us to a crucial practical test. What happens if you run into some uncertainty, say in an exam or out in the field, about whether an item actually meets the definition of clearly trivial? You have to know the standard's exact position on this gray area. And that position is absolute. There is no room for debate. If there is any uncertainty at all about whether an item is clearly trivial, then it is not clearly trivial. It's that simple. It must therefore be accumulated right alongside the other identified misstatements. Section 5. Revisions during the audit. There's one final requirement that completes this picture, showing how these precise thresholds live and breathe from planning through to the final report. Materiality isn't just fixed at planning and forgotten about. If you become aware of new information during the engagement that would have caused you to determine a different amount initially, you have to revise it. And if you revise the threshold, you then have to consider whether the nature, timing, and extent of your further audit procedures need to be adjusted to match. So, let's lock in the correct mental map before we finish. Materiality for the financial statements as a whole is your overarching threshold for the users. Performance materiality is your internal working margin that protects that headline figure. And clearly trivial is the absolute floor, below which nothing needs to be collected at all. As you head into your next engagement or exam scenario, take a moment to ask yourself if you truly understand the scale of the errors you're hunting. Remember, 3 amounts, 3 purposes, and questions that turn on knowing which one is being asked about.